What is an IUL laser fund? Well, IUL, if you're not aware, means Indexed Universal Life, but don't prejudge it. It is the dream solution for many financial goals, and in this episode, I'll explain why it knocks the socks off of most traditional IRAs or 401ks for retirement planning, but it also knocks the socks off of a 529 college savings plan, or working capital account for your business or for real estate management, an emergency fund at a bank or credit union, pension maximization for school teachers, police officers, firefighters, on and on and on. So an IUL laser fund is a properly structured IUL, and the vast majority, over 99% of IUL in America, is not structured or would be deemed a laser fund. Laser means liquid asset safely earning returns. So get ready. I think you're going to be blown away when you understand what an IUL laser fund really is. So I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for 5 decades, helping thousands of Americans optimize their assets, minimize taxes, and prepare for a comfortable retirement. Now, if you've watched very many episodes on this 3-dimensional wealth channel, you'll soon realize my favorite financial vehicle, without question, for retirement planning and a lot of other financial goals is a properly structured, maximum funded, indexed universal life insurance contract. Now, when I say properly structured, maximum funded, that means you're using this insurance contract for living benefits, which is what universal life was designed for in the first place back in 1980 when it was first introduced by E.F. Hutton. They had an insurance division, but they were primarily a brokerage firm, and they realized that in the Internal Revenue Code, now for over 110 years, there's really only one financial vehicle that allows you to accumulate your money tax-free, That's under Section 72E of the Internal Revenue Code. And then be able to access that money, including all the gain, the growth, totally tax-free while you're alive, and create tax-free income so you can access it tax-free. And then, as long as you leave a little bit in there, at the end of the day, when you ultimately die, whatever you leave in there blossoms and transfers income tax-free to your heirs, your spouse, your kids, your grandkids, a church, a charity, or whatever. Now, that's under Section 101A of the Code, which is the secret behind this. Section 101A of the Internal Revenue Code creates this sacred tax-free cash cow, a permanent life insurance contract. But see, up until 1980, there was only term insurance and whole life insurance. And so whole life insurance has term insurance in it, The cost of insurance gradually goes up as you get older, but with whole life, you pay a level premium generally for your whole life, and so you're way overpaying the cost of the actual insurance during the early years of a whole life policy so that you can underpay later. So you pay a certain premium, you're overpaying the early years, and that creates cash value or equity in the policy that then covers or keeps the policy in force based on guarantees in the contract. If you live beyond, let's say, age 65, when the premium you're underpaying, but because of all this cash value that you've built up, compounding interest, and it's tax-free, it covers you for your whole life. But it was designed primarily to keep the death benefit in force for your whole life, and that's what basically the guarantees are there for, But it was primarily used for death benefit. E.F. Hutton, back in 1980, said, wait a minute, why don't we use it for living benefits? So I'm going to simplify this. They basically said, why don't we use life insurance, permanent life insurance, and use it more for the living benefit and the death benefit. What you leave behind when you die is the secondary objective. Let's not worry about the death benefit so much as let's accumulate our money tax-free, because this is tax-free under Section 72E. Section 7702 says you can access your money out of that cash value without paying tax on it, and yet you can create income. Now, let's say you accumulate $1 million of cash value in a policy, and you can extrapolate from this example that more or less based upon a given point in time if you own an IUL. But with $1 million in there, with a properly structured and managed IUL, I can access money. I can access, if I have $1 million in there, I could access over 900,000 of that within a few days, and it would be totally tax-free. Even though maybe my basis in that policy 7.5 years earlier or whatever was only 500,000, and it doubled to $1 million and so forth, because the rate of return can be very, very great because you can access that money. But what if you just want to retire and take income? Well, if you understand IUL, there's very powerful ways that you can access money. You could just access the interest that you're earning on it, and you can pretty much count on, if you manage it with just coming in for an annual review, 8% is really conservative. So $1 million of cash value in an IUL policy can generate $80,000 a year of tax-free income. If you retired at age 65, that could last till you're age 120 if you live that long without depleting your $1 million based on actual historical performance, okay? To be honest with you, most whole life policies would be hard-pressed to do that. But most of my clients have experienced what I have because we use a principle of arbitrage. And so we actually borrow the equivalent of our interest from the insurance company based on the cash value that's collateralizing it. And we borrow it using an index loan. I don't want to get too complicated in here, but if I have $1 million in there, I can, and if it's generating, earning 8%, I could actually borrow 10% or $100,000 a year from the insurance company, and they loan me $100,000 a year based on the collateral. And the reason why they can do that and it will not deplete my $1 million is because not only are they earning, let's say, 8, but I can pull out 10% and not deplete it, because if I'm borrowing, they're collateralizing it with a cash value, and I'm telling them just leave the $1 million alone, and they're earning interest. And I'm earning interest usually at a higher rate by at least 2% higher. But many years, when you borrow, the insurance company has to legally charge you an interest rate. They might charge you 2%, and they credit you 2%. It's a zero-wash loan, but why do you borrow money out of an insurance policy? Because you don't have to pay it back. It's not due and payable during your lifetime. It's washed away when you die. Because loan proceeds are tax-free. The IRS actually says if you take out your money and call it a loan, you won't have to pay tax on it. And the loan is paid off or washed away with this compounding money that's growing. But the insurance company, if it's IUL, will continue to credit you the indexing rate on all of your money. So many years, I've been credited 10, and they're only charging me 4 or 5 at the most, okay? So I'm making a spread because I don't have to write out a check for that, because if they're charging me 4%, I'm banking 10%. I'm making an extra 6%. And so many of our savvy clients, they make at least a 2-point spread doing that. So instead of just settling for $80,000 a year of income, most of our clients can get a 10% payout without depleting principal, and their million in this example just keeps growing, okay? You need to watch other episodes and read my book that I want to gift you a copy of to understand this fully. The point is this: what is an IUL laser fund? Well, it's an indexed universal life insurance policy, but it's structured primarily for living benefits, for the tax-free income. When E.F. Hutton came up with this idea, they said, if we're going to use this for living tax-free benefits, let's take the least amount of life insurance that the IRS will let us get away with, and let's put in the most premium that the IRS allows as fast as they allow, and this thing turns into a tax-free cash cow. Now, what did I mean by saying that? See, an indexed universal life policy is just a life insurance policy where you have a death benefit, but so many of them out there are just structured so that if you averaged 8% by having it being managed right, you might only net, 4 or 5%. To be honest with you, if a whole life policy were to experience 8%, rates of return or dividends, you're only going to net about 5.9% at the end of the day, cash on cash. That means the actual cost of insurance gobbled up 2 of the 8% that they said you were earning. A lot of times they don't tell you what the net rate of or internal rate of return is. And usually it takes till at least 95 if you were earning 8 to only net just less than 6. With an IUL, I can net 8, okay, cash on cash. I can net 10 by rebalancing every year because I'm structuring it differently. Basically, an IUL, when E.F. Hutton came up with it, it allowed you, under IRS rules that were passed in the 1980s, TEFRA, DEFRA, and TAMRA are the 3 tax citations. Those are acronyms that stand for the Tax Equity Fiscal Responsibility Act of 1982, the Deficit Reduction Act of 1984, and the Technical and Miscellaneous Revenue Act of 1988. The point is, you comply with those 3 tax citations, you take the least amount of insurance you can get away with, and you put in the most premium the IRS allows as fast as they allow, and it turns into a tax-free cash cow. And you don't worry about the death benefit. So you get away with the least. So let me use an example of a 60-year-old. Okay, if I had a 60-year-old, you would think, well, an older person, the insurance is more expensive. Not if you're doing it for living benefits. The cost of insurance is the same for the 60-year-old as a 78-year-old, that I'm going to talk about in a moment, as a 22-year-old athletic marathon running female. Why? Because the IRS gives parity if you're using this IUL for living benefits. The older you are, the less insurance that is required to accommodate the amount of money you want to have grow tax-free and to generate tax-free income. So let's say a 60-year-old wants to reposition $500,000. Now, if a 22-year-old wanted to reposition $500,000 and it was a female, they might need $5 million of life insurance in order to have it be tax-free. A 60-year-old only needs $1 million of life insurance. People say, well, who pays $500,000 for $1 million of insurance? Well, our clients do, because they're not interested in they want the least amount of insurance. So stay with me and I'll show you why. I had a 78-year-old that had 3 blocked arteries, adult onset diabetes, a prostate cancer episode, 6 sisters predeceased and 3 brothers. He was rated Table D, which is 100% rate up at age 78. He had the life expectancy of an 83-year-old back in the 1980s. He put in $500,000 into his universal life. He earned 11 and netted 10, just like a 22-year-old female, because the cost of insurance for that 83-year-old, effective 83-year-old, was the same as a 22-year-old female, because he only needed $750,000 of life insurance to accommodate $500,000. Okay? He wanted to earn 11 and net 10. That's what you want to do. You want to have the best internal rate of return and have the cost of insurance actually be cheaper as you get older. And people go, I've never seen an insurance policy do that. Well, then you haven't seen one done the way I'm talking about. If it's done correctly, it's a laser fund, liquid asset safely earning returns. So listen closely. Let's go back to the 60-year-old. If I have a 60-year-old that wants to reposition $500,000 to increase liquidity, safety, rate of return, and the tax benefits, he can put in $500,000. The minimum death benefit under tax rules is about $1 million. He doesn't care that it's only $1 million, okay? He puts in $500,000. It usually takes at least 4 years and 1 day to do that. If it's index universal life, it takes 7 years to get it in there if it's whole life. That's one of the reasons why index universal life will outperform whole life, because you can get in the money quicker and you can get away with less insurance. Maybe whole life would require $1.2 million of insurance or whatever to accommodate 500,000. The point is this: when he puts in 500,000, he can opt to have that added on top of the million when he dies. That's not what we recommend. We recommend the level death benefit. You want to self-insure. If he gets the $500,000 in there in 4 years, let's say in one day, the net amount at risk, the million of death benefit, 500,000 of it, he can opt to have be his own money. The insurance company is now only going to charge him for half as much life insurance. So even though the cost per thousand of life insurance goes up, the amount of insurance he's paying for in 4 years and one day is half of what it was 4 years earlier. That 500,000 at average returns will double to $1 million in another 7.5 years. So in the 11th year, I've had many clients where the 500,000 of cash value grew to equal the death benefit. Now she's self-insured. There is no cost of insurance because the death benefit, the cash value has grown to equal the death benefit. Now, if they happen to die, the insurance company pays out, 5% more. But the cost of a little bit of 1/20th of life insurance is so much less than the interest he's earning now on $1 million. And that $1 million can generate a 10% payout tax-free. That's a laser fund. A laser fund is an IUL structured to take the least death benefit you can get away with and put in the most money as fast as they allow. And it turns into a tax-free cash cow. It's the dream solution to all kinds of financial goals, not just retirement planning. So watch other episodes that are shown here or claim a copy of my book, The Laser Fund, 300 pages jam-packed with charts, graphs, and explanations, and 62 stories on this side. Go to laserfund.com, contribute a nominal amount towards the shipping and handling. I'll cover the rest of that. I'll pay for the book. I'll fire out a hard copy to you, but you can even schedule to talk to an IUL specialist, no cost, no obligation, to see how a properly structured laser fund is an IUL structured to help you for living benefits.